All right, so today I want to finish up some stuff on capital management, capital budgeting. I think we had one more class after spring break on it, but let me mention on the Excel applications. So the first one I'll email out. The first one is listening to the podcast. That'll be due the week after spring break, so you can go and get working on that. But the next three, number 2, 3, and 4. You got everything you need. So what I need to do is get you the links to the Excel the YouTube videos, and I'll get those to you this Friday. So if you want to get ahead, you can do the next 3 very easily because we've already done this. The time value problems that we did some in class, it's the capital budgeting ones, and the video walks you through it. So they won't be due the week after spring break. Will probably start being due the 2 weeks after spring break, and then essentially almost 1 a week after that. They're all, once you get to that one, they're all practice for the second exam. So, and I'll start putting up places on Blackboard for each one of them. So there'll be place for application 1, application 2, 3, all the way throughout. So you'll just load each one of those. I don't give you feedback on those, but I do take notes. So if you get like 80% on one, and like, what did I miss? I do, while I'm grading it, I'll do a text box that tells me what you missed. And so you can always email. I'm not going to tell you though, because it's just too much for me to type a bunch of emails. So if you miss some, the biggest mistake students make is they'll do problem 1 and then they'll take problem 1 and copy it for problem 2 and forget to change some of the numbers. So the cost of capital or the growth rate or whatever. So just double check to make sure you have all those numbers when you bring it over. All right. Any questions on any one of those? All right, so the first question I want to bring up is, I want you to assume the project is a purchase, no debt. All right. So if you're buying a car, I want you to buy it all with cash. You're buying a house, buy it all with cash. If you're doing a franchise, pay the franchise fee all with cash. Now, are you actually going to do that in practice? No. Am I asking you to do this for simplification purposes? No, this is how you're supposed to do it in real life. The big debate is with the real estate people, and I'll give you some sense of why they think that's so important. But let me show you why I think that. So here's a mortgage right here. You borrow $500,000, 5 years. It's a present value interest factory annuity. You remember that? So you take the $500,000 divided by that present value, and that tells you what your payments are going to be. There's your interest. That's a 500,000 times your, this is on an annual basis. I didn't do monthly, but on an annual basis. Y'all seen how to do this, right? You're going to do this on the Excel application too. Pretty straightforward. Well, let's do a project that's $1 million. And our cost of capital is 5%. So we do this project, and let's assume no mortgage at all. All right. So what is our present value? Our present value is $114,257. Just using the X NPV, or just taking the present value of each one all the way down. I hate this thing so much. So 114,000. That's if we did it all with cash. Let's change our opinion now and do it with a mortgage. So our cash flow is no longer $1 million. Our cash flow is only 500,000. But our benefits are lower. Why are our benefits lower? Because you're paying the mortgage. All right. And our discount rate is still 5%. Whoa, look at that. Our net present value is exactly the same. But that's not what real estate people do. They make a big mistake. So let me show you the big mistake people make on this. Their cost of capital is actually 663. Why is that? Well, because their cost of debt is 5%. We're going to learn this. We're going to do cost of capital. You have 2 sources of capital. You can borrow money, or it can be your own equity capital. If you borrow money at 5%, you're probably going to require a higher return than that. And why is that? Well, the people you borrow money from, if you mess up, they get everything. They get the building, they get your car, they get collateral, whatever. And you end up with nothing. So you're taking more risk. So if you're the equity investor, you need a higher return. We're going to call this KD for cost of debt and KE. So you're going to see this when we do cost of capital. Cost of equity, KE, that's your investment as the investor, is always going to be higher than the cost of debt because you're taking all the risk. All right. So our WACC is 663. Well, what real estate people like to do, they say, okay, 663, our net present value is 65,000. Let me do this with the 663, but let me do the mortgage. And they say, wow, look at that. My net present value is higher. It's 86,000 if I do the mortgage versus it's 65,000 if I do it on my own cash. And that's what, and not to pick on real estate people. Andrew's not here, so I can pick on real estate. We have other real estate people here. All right, so Mariana, so this, you got to watch for this. What was the flaw that they made? Well, here, they're using 663 because they're assuming when they do this project, they're going to have some of it funded by debt and some of it funded by equity. So the correct discount rate is 663. Because this cash flow is going to go both to the stockholders and the bondholders. So that 63 makes sense. But down here, whose money is this? Who gets that? That's net of the debt. So that belongs to whom? Just the stockholders. Can we use 663 if it's only the stockholders' money? What's the stockholders' cost of capital? It's 8%. Right? So if you use the 663 when you do the mortgage, you've misstated. So what you have to do is you have to use the cost of equity capital. When you do that, you get the exact same. All right. Now, I went fast on that, but there's the key. So if you want to do the debt, you have to do two things. First of all, you have to set up the debt schedule, which is kind of a pain. Not horrible, kind of a pain. The second thing you have to do is you have to use a different discount rate. So if you do it without the mortgage, you use your cost of capital. If you do your cash flows net of the mortgage, you use your cost of equity because that's only your cash. I think that's the key. If you put the mortgage in there, you use your cost of equity. If you do it without the mortgage, you use the cost of capital. Where real estate people make a mistake is they like to use the cost of capital, even when they're looking at money that's only the equity holders' cash. So they're using too low of a discount rate and say, wow, we got a higher net present value. No, you didn't. You used the wrong rate. So if someone says, hey, we'll get a higher net present value if we use debt than if we don't, they're using the wrong discount rate. And that's the first thing you would say. So Mariana, if you say, hey, we should use debt because you get a higher net present value. No, you don't. You should get the exact same net present value unless you made a mistake somewhere. So it's really, really critical that you don't say this project is better using debt because it's riskier using debt. And we've already captured that in the 663. Now it's kind of a esoteric point, but it's extremely important because it's pretty basic to finance that you got to make sure you're using the right discount rate. Otherwise, you can get the wrong answer. But the good news for you is you don't have to worry about mortgages. You don't have to worry about borrowing money at all. You just do it as if you did it with cash, entirely purchased with cash. And as long as you're using the right discount rate, you're going to get the exact same answers that you would have gotten if you used the debt. So it kind of simplifies it for you, and you don't have to go through all the extra work. You don't have to. You're going to assume the real assumption is we're going to get $500,000 from the bank, and we're going to put the other 500 in. But that's reflected in this 663. It's already there. And so even though I say we're getting $1 million, this 663 is already assuming some of it's debt and some of it's our money. So the 663 is assuming a certain capital structure.
One scenario may be more viable getting investors or pay the capital up front, and so you're able to split 500,000 over the bank and pay that incrementally.
Well,
over time.
If you can't get any debt at all, then what's the right discount rate here? It's 100% equity. What's going to be your discount rate? It's going to be 8%, right? So if you're saying, hey, we can't borrow money from anyone, this is all our money, then you're going to use an 8% discount rate. Right? Which means your cost of capital is 8% because you're not using any debt. If that's true for this project, it's probably true for all projects. Okay, so yeah, so you got to ask, whose cash is this? Oh, well, the cash is 46% debt, 54% equity. Okay, well, the correct discount rate is 663. 46% at 5%, 54% at 8%. Okay, so that's the nice thing about discount rates is they already assume a certain amount of debt and equity. It's already in that number. You don't need to then add the mortgage in because you've already captured it in the discount rate. Now, if you think something's happened, you can't get debt anymore, then yeah, that just means you go 0% there and 100% there. And that becomes your new discount rate. Most firms have a target capital. And they say on most projects, we're going to be 50-50. And that's what they use for all projects. If your project's special, then you might use a different discount rate to reflect the fact you're using a different. But again, if you say, hey, this project's only going to be 20% debt, something unique, you still don't set the mortgage up. You simply adjust your discount. Makes it really simple. Now, why didn't I use 50-50? Well, it's not technically 50-50 because when I pay down the debt, some of that's interest, some of that's principal. So my weighted debt is actually declining over time. And that's why it's not exactly 50-50. It's a little bit lower. I actually had a former student email me a few years after he took my class, and he was having this debate with his boss. So I had to send them. That's why I created a spreadsheet. I wanted to prove to him that you should get the same answer because it really is the same answer. All right. This probably is going to have to take a while to sink in, but the real key is don't put debt on your project. And just trust me that I proved it to you if you're not catching all of that. All right, the second thing I want to show you is, I don't know if any of y'all are doing, do we have cases yet? Y'all haven't sent me your cases. So do we have CBAs? Team one, did y'all decide? Who is team one? Emmanuel? What did y'all, you tell me when you're interested in it. Sounds like it might be a little tricky. Oh, Apple Pay. Okay. Yeah, that's one you're going to probably check that you have access to, but we'll see. You might want to have a backup just in case. Team two, did y'all decide? Space travel. Now, do you mean space travel, or do you include sticking satellites up there as well? But so be clear. Do I need to send y'all that economics article? It's probably a little. You have it? Okay. Team three, did y'all decide? Okay. Team four. What's team four?
We talked about the heat pumps versus air conditioning.
Okay. There was a huge article about that in The Economist. I don't know if you saw that. Yeah, it was interesting. So they even have some numbers in there. It's in the UK, so it's in pounds, but it's probably real similar. So that's the same issue in the US then. You can use a heat pump instead. Okay. You're talking about for a house or a business? I mean, it's just one of the things you need a lot of costs for it to save. Okay, I was actually thinking of that one, so that's interesting. All right, team five, did y'all decide?
Yes, we're making smart shopping carts for both foods. That was our current one. We're giving it backup.
So is Amazon already doing that somewhat?
Yes.
So you're gonna back test to see if it was a good.
Yes, but mainly for produce products because they're doing it for like,
Okay.
well, I don't know how to say it.
Well, all right. So do they have to package the food in advance by weight or something, or how do you get the weight?
Here we have full foods. Because they usually do by weight.
All right. So Okay, that'd be interesting. I was wondering if they could actually do it. All right. And yeah, so some of y'all are gonna need a backup. Definitely. So some franchise, yeah, franchises are a safe. All right, and then team 6. Where's team 6? Is that Joshua? Is that y'all? Are y'all team 6?
Oh, no, that's.
No, ahead. Y'all team 6? Did y'all decide? All right, well, let me know as soon as possible. So no one's doing a franchise, but
Well, no, we were doing it. in Airbnb as well, but-
okay. Yeah, I was talking to the team. So if you do the Airbnb, you might add an extra case for renting out because it would be a cool in comparison. The nice thing about renting out is your vacancy rate's not going to be nearly as high. You can't charge as much, but your vacancy rate won't be nearly as high.
That's the- Not do it by itself, so renting. There's not enough upfront cost to capture renting.
Oh, I don't remember that. And you can certainly say, do I buy a condo or rent an apartment? You can certainly do that. But all right. So y'all aren't doing franchise. Well, let me show you a franchise typical because you might have this project in one of your so the key here is your revenue. So you go to the franchise and they tell you what a typical revenue would be. Hopefully they give you that information. So I don't know what franchise this is. Might be McDonald's, $1.1 million. I'm assuming my revenues are going to go up 2.5%. But my first year, I'm only going to have 50%. It's going to take a while to get people to kind of decide. If it's a McDonald's, it's going to be a pretty fast ramp up. People, once a McDonald's is there, you don't have to advertise. They show up pretty quickly. If it's, some of the more esoteric ones like Orange Theory may take a little bit longer. So I'm just assuming, okay, my revenue is $1 million. That's going to grow 2.5%, but I'm only going to get 50% of that. And then by the 6th year, I'll have the full amount. My cost of goods sold, that's a variable cost. I'm saying that's 30% of revenue. Hopefully the franchise will tell you that, but you want to know what that is. This was our big issue with Smoothie King, is they wouldn't tell us this number, which is a pretty important number because milk and fruit and all that, that's expensive stuff. And they didn't tell us that number. So it was really frustrating. And you want to know, does it include the food? Does it include the wrappers, the paper, the cups, the straws, all that kind of stuff? You're hoping it doesn't include your labor because you definitely want to do labor separately. So cost of goods sold 30%. Since it's 30% of revenue, you don't have to worry about inflation because that's already in your revenues inflation. The royalties, they'll generally tell you what that is. And then your workers, you'll probably have a whole page you set up the workers. You might ask how many workers do you need? You have to put that in. And so you have, this is what I'm going to pay each worker. This is how much I'm going to increase my pay. Here we increase it faster early because the minimum wage discussion's going on, that might have some impact. And then I have a manager. I'm going to hire a manager, what I'm going to pay them. And then my operating expenses growing at 2.5%. So I have all my cash flows. And now down here, I just do a typical net present value kind of thing. So I lose money the first couple of years because I'm just ramping up. So the key with a franchise is getting the revenues right, and then hopefully you got good data. When you're picking a franchise, you want to make sure most of them are really, really clear on the advertising and royalties. Most of them will tell you that right up front. Most of them, they all will tell you what the initial investment is. That they'll tell you up front. Here they tell you exactly what it is. And then the ongoing operating costs, I got those from them and I just put that in there. But notice this is really important for all of your cases. So I say the operating costs start at 204. You got to make sure you're inflating these costs. There's no cost out there that I can think of that's not going to increase with some kind of inflation. I mean, not the same rate. None of you are doing electric cars, but CPS's rates have been really, really stable. You can look at that historically. So you might assume gasoline prices are much more volatile than CPS rates. That's fine, but you're still, CPS is going to be charging more 5 years from now than they are today. You would still increase it some, all right? So inflation is important. So in a franchise, the whole key is capacity, and you kind of ramp it up. This weekend I went to HEB, and they were training a new person, which has got to be the scariest thing. She was so friendly and so sweet, but so slow. And so the lady ahead of me was getting irritated. And it's a horrible thing to do something, because this is a Sunday, is a pretty busy day. So you have to think about that when you start off. Your workers are not going to be very well trained. They're going to be slow. How do you handle that? It's just frustrating. I think HEB should do something along the lines of, we got trainees in this line. We'll give you a 5% discount if you'll use this line, kind of thing. So the people go in knowing. And that way the workers, you're not so stressed, right? If you know you're giving them a discount, so hey, if I mess up, they're getting something out of it. I think that would leave that. The lady bagging was really helpful and kind of kept the stress down, but she kept hitting the wrong button. And oh, the poor lady. I mean, it's just frustrating, right? A new job. So you have to realize that with the franchise, not only are you learning everything, but probably most of the people that you're hiring are going to be brand new to this. All right, so that's how franchise, pretty straightforward. The key in all of these is to get to that net cash flow. Once you have that, everything else in the spreadsheet is the same as you see in that Excel application 3. Now we got 2 real estate ones. So this is the one I want to show you here. So I would recommend y'all do this. If you want help on this one, I'll definitely help you here. But what I decided here was that if my rent, let's say my base case rent is say $16.50. I think I can charge $16.50. Or if you do an Airbnb, maybe do this on a nightly basis. Or my nightly will be. So, but if I can only get 500, I must have a really high vacancy rate. There's something wrong with this market. And when I resell the house, it's going to be 25% less than what I bought it for. So that's the bad situation. And I just go up and rent. At the very top, I get ridiculous. I want a full range. At the very top, if my rent is as high as $5,000, I have almost no vacancy. 5% just because people move. You can get some people because of summer moves or whatever, but probably going to be able to refill it pretty quickly. If I'm able to charge $5,000, I'm probably going to have people coming in very fast. And then my resale up to 20% higher. Right. And so what I'm going to do now, watch if I change this 1,600 to 1,500, watch what happens. Vacancy changes and appreciation changes. And how did I do that? Do y'all know how to do VLOOKUP? VLOOKUP is a wonderful thing. So what does the VLOOKUP say? Look at the rent, the 1,500, and go over to this table and go down this table. The comma 2 tells it, I don't need an exact match, but as soon as you get close, go to that row. All right. And when you go to that row, I want you to go over. I'm sorry, that's not what the 2 means. I'm sorry, the 2 means to go over 2 columns. 1, 2. So it's going to pull the vacancy rate. You can at the very end do true or false. Here we're doing true, which means we want an approximate match. We don't want an exact match. Otherwise, the break-even calculation is not going to work. So true or false. So if you want an exact match, you want to use the true or false. So I like using this like when I'm doing the stock market. So I might want to do an analysis where the S&P 500 and have the 10-year treasury. Well, the problem is the stock market and the bond market have different holidays. So what I can do is the VLOOKUP and tell it, hey, find this date and go find the 10-year treasury on that date and line it up with the S&P 500. It works really. Have any of y'all used VLOOKUP before? No, it's really powerful, really, really useful. Same thing here on the appreciation. Go find that 1,500, but now go over 3. Now you have to be careful on the 3 because you have to count the first column. So 1, 2, 3. You might think that's 2, but that's actually 3. All right. And now what I can do with my break even, I can do data just like I showed y'all on the Excel application. What if goal seek, I can tell it, make my net present value equal to 0 by changing my rent. And I now have a scenario. I was able to run 3 different scenarios. So, that would make like 27 different scenarios because you have to match them all up. But I'm not going to do that. I'm not going to do 3 scenarios for rent, 3 scenarios for vacancy, 3 for appreciation. Instead, what I'm going to do is make my rent define what my vacancy and appreciation. And that makes perfect sense to me. The higher my rent, the lower my vacancy, the higher my appreciation. So if I can get at least $1,500 in rent, I should break even on this project. I'm starting at 1650, so I'm not that far ahead of my break even. So I better hope this market holds up. I am in San Antonio. San Antonio has been a fairly safe real estate market. I don't know what our housing prices are doing now. I sold my mom's house last year, and boy, Austin's down a good 20%. So I'm kind of lucky I got that one timed. I don't think San Antonio's quite seeing that drop the way Austin is. All right, so the 2 real estate teams, if you don't understand how I did this, email me. I can send you this file and you can look at it. But your other teams may find an approach for this as well. So let's say there's 3 things you want to look at and they're related to each other. This type of table is a really good way to do it. You can do it as an algorithm. Have a formula, kind of a regression kind of formula with your intercept plus a slope times some number. You can do that, but instead of doing that, I set up a table like this. And anything you can find that helps you build this table, the better your analysis is going to be. Right? Any questions on that? Does that seem to work? Pretty powerful, pretty easy to do. And you see why if I did the false, that it wouldn't work as well. We'll see. Because what the false is telling you is go find the exact number. If they can't find that exact number, see, it doesn't work. You can't do the break even anymore. So don't do the false, do the true, because you just want an approximate match. So if y'all want this file, let me know. I'll save it out there. You can email me, or maybe I'll put it out on Blackboard. We'll see. There's a lot of other pages to it, but it's only the break even you want to look at. Now there are ways to do Excel's pretty powerful. So if you want to do simulation, you can actually do simulation. I don't know if any of your classes I've shown you that. I highly recommend the accounting and finance majors take, and even marketing majors too. Marketing majors take a modeling class, and hopefully they'll show you how to do simulation in Excel. But Excel has a random number generator, and you can set that up, and you can set up your parameters, what your distribution is, and you can use that, and you can actually run scenarios. So I'll be impressed if one team actually ran a simulation of their, and that way you don't have best case, worst case, and base case. You actually have a distribution of your project, which is really cool to do. So you could certainly do that. And every time you hit calc, it gives you a new number. And you can even do rand, I think rand between. And tell it what range you want it in. I don't know why I did that. No, I don't know what I do. I don't know what. So rand between, I did something wrong there, but that should have worked, but I messed it up. Let's see, what are you supposed to put in there? Oh, bottom, let's see, 0, top, 50, 20, 17. I guess you have to use integers for that. So anyway, so Excel has some pretty powerful stuff. Why is that important? Your first job is probably going to be heavy Excel. I don't know about the cybersecurity, but all the rest of you is going to probably be heavy Excel. So you need to know these little tricks. If you want to teach yourself, there's a YouTube channel called Excel is Fun. And they do all of these things. You can go teach yourself, just take all their videos. I think they just have, and the other one is the corporate finance. What's the name of that group? They have a capital IQ tutorial. Yeah, this group right here. I don't know if y'all have seen them. Corporate Finance Institute. Y'all familiar with them? They do some really great videos. So they have, it's always this guy though, so I don't know how much they pay him. So Excel crash course, introduction to corporate finance, how to link the 3 financial statements in Excel, how to build forecasting model. That looks really, really good. Sensitivity analysis. That's essentially what we're doing, right? Best case. So he's covering a lot of stuff that we're doing. Monthly budgeting, forecast model, how to build a financial model, index match. So the index match is very similar to the VLOOKUP kind of thing, where you're using Excel to go find something for you to be able to update your analysis. So I mean, I don't know how many videos they have, but it's a bunch of them. Quite a few videos. I haven't watched these down here, but this first row, that guy does a lot of videos. All right. So get better and better and better Excel. The Excel applications for this class will help somewhat, but that's fairly basic stuff. So there's nothing particularly massive there. If you're one of these kind of people, yeah, stop doing that. Right? Don't do that. You always want to. So how do you know you're good in Excel? You're not using the mouse. If you're using the mouse, you're doing something wrong. So I still use the mouse because I didn't learn the keys in Excel, but I knew the keys in Lotus. We learned on Lotus, and we didn't have a mouse. When I first started, there was no such thing as a mouse, at least on the computer. And so we learned to do it with keyboards. And I remember when the mouse showed up, I was like, okay, this is bad. Because I was so fast on the keyboard. There's people actually would come to my desk just to watch me. They thought I was joking. I was like, no, I'm actually doing stuff. And when the mouse showed up, it's like, it's going to slow us down. But it's funny, we've gone full circle. Since I started my career, we're now back to don't use the mouse, use the keyboards. So that makes you much faster, because reaching over to touch the mouse takes you 10 seconds. If you're doing something 1,000 times a day, 10 seconds adds up, and you leave at 5 o'clock instead of leaving at 9 o'clock. If you can do that. So there's plenty of places out there, a lot of free stuff that are really, really good sites. All right. We'll come back to capital budgeting. I want to do this one little case here as a capital budgeting case, just to show you a real life example. All right, so here's the scenario. This guy's looking at spending $15,000 on a wind turbine, and he wants to put it in his backyard. And his neighbors aren't too happy about it. And obviously for good reasons. Just a second, let me. So let's set it up. So you got time. We're going to do this in years just to save us some time. You got the investment. You got the savings. So your investment is $15,000. That's at time 0. at year one, your savings are going to be $20 times 12. And let's use an inflation rate. Let's say inflation's 3%. So time 2, he's going to save 240 times 1 plus 3%. So how many years out? He says, even if it was 50 years, it's worth doing it so I can save the planet. And in 50 years, his electricity bill is going to be $1,000 less. All right. So what discount rate will you use? Weighted average cost of capital, let's use 5%. Net present value, I remember the formula for that. Let's do this. Let's do equal today plus that plus 365.25. So in 2073, he wants to be ahead. So y'all remember the net present value equal X MPV? Y'all remember that? So the rate's 5%. The values, oops, excuse me. There's my cash flows. So equal X NPV. My rate is 5%. My values are right there. And my dates are right there. So how did he do after 50 years? Accept or reject? The net present value is negative $7,600. Reject. What if inflation were 4%? Still reject. What if it's 6%? Still reject. Does this sound like a good project? Doesn't sound like a good project. He said, even if it takes 50 years. Yeah, sorry, but 50 years is not enough. We need more than 50 years. So it's not a good project. Now, maybe he means 50 years where undiscounted. So no whack. And I don't know why I get close to 0. If his discount rate's essentially 0, then it makes sense. So yeah, his payback undiscounted is less than 50 years. But you know, we can see how far out you have to go before you get your money back. So sometime in 2059, he goes positive on a discount, I mean on a payback period, but not a discounted payback period. So doesn't make sense. Anytime I see these articles, I think I saw this in The Economist, but when I see an article like this, I always sit down and do the math. I'm just really curious. I've seen the city of San Antonio have articles like this, how much they're spending, what the benefit's going to be. I'll immediately sit down and see, is this net present value positive? So it just shows how my warped finance mind thinks, but that's, you know, pretty critical. Brandon's teaching the ESG class. I just sent you a bunch of articles on all debates. There's a lot of debates on ESG, and that is the big debate. One of the reasons I showed y'all in the list, that Borg, you probably don't like that guy, the economist, but he has a website which asks, okay, global warming is going to be an issue. Where's the best place for us to spend the money? I kind of like that kind of analysis. So yeah, you could spend 15,000 on this, but maybe you should spend the 15,000 on an electronic vehicle instead. Maybe that would do more for the ecology, and you'd actually come at it. You know, those kind of things you got to ask is, where's the best place? So I'm hoping people aren't saying we're going to spend $20 trillion on this to save the planet, when we could spend $5 trillion and get more benefit and get it fat. You know, so I'm hoping people are doing this type of analysis, and that's what his website does. He sits down and say, where could we spend money? What's the benefit? What's the cost? And so this guy didn't quite do the math, and his neighbors are like, yeah, you're just trying to show off, and no one's winning at the end of this. Now, some of y'all probably strongly disagree with me on this one, but that's my feeling on plastic straws. I hate paper straws. You know, some of y'all are probably out there crusading for paper straws, but I hate paper straws. I feel like I'm eating paper anytime I use them. So I just get a plastic straw and I use it a million times. So maybe I'm saving the economy. Like today, when I get cup, when I buy drinks, I always have my styrofoam Coke cup that I keep reusing. I prefer to reuse over and over again because I don't want a paper straw because it just messes up. I don't think it's changing the environment, but someone could show me the math. I've seen debates on the bags you use for shopping, grocery shopping. There's some debates on that, how long, it takes quite a bit of CO2 to make the bag itself. So that's what I want to see. I want honesty. I don't want to, I'm great, let's save the planet, but let's do it in the best ways possible. And that's what finance is going to say. That's what economists are going to say. What's the best way to spend that money so we benefit the most? So, all right. So that's cost benefit analysis. You'll get a little more practice on that with the Excel applications. I want to jump to a third discounted cash flow analysis. So we did time value money where you're doing auto loans, borrowing money, those kind of things. The second one was the net present value, that application. The third application of time value money is valuing an asset. All right. So on the exam, you'll do two assets. You'll value a bond and you'll value a stock. You have those two. Two of the ones related to the stocks won't actually be on the final exam, although I'm tempted on one of them to put it on the final. But the bond definitely will be. And when you value a stock or a bond, it's the same thing we've been doing. It's just the present value of those future cash flows. But those future cash flows are what? They're a forecast. Now, if I'm valuing a treasury, how hard is my forecast going to be? So if I loan the U.S. government $10,000 for 10 years and they pay me a 6% coupon, could you do that forecast pretty easily? They're going to pay me 6%, but twice a year. So they'll pay me 3% twice a year. So they can make 20 payments. And at the end of 10 years, they're going to give me my money back. Is that a pretty easy forecast to do? Pretty easy, isn't it? How confident are you? You're loaning money to someone that can print their own money. The only way they don't pay you back is if, they have a debt ceiling and Congress decides to destroy the entire economy, which is possible, but hopefully not. Hopefully Congress is going to pay their debt. So yeah, that's an easy forecast. What about Alphabet? So right now they pay no dividends. So their current cash flow is zero. Does that mean Alphabet or Google is worthless? If I had Google stock and I say, hey, you know what? I did my valuation, their cash flow is zero. The present value of that is zero. If you want this stock, I'll give it to you. Any of y'all take it for free? If I give it to you for free, you'd probably take it. But my valuation said it's worthless. So what's the value of Alphabet? Well, you say eventually they pay dividends. That's one approach. That's the approach we're going to take. The other is we won't value the company, the stock. So instead of valuing the stock, we'll value the company. The company has cash flows. We can value that. The stock doesn't have any cash flows, but we as an investor in the company, we get those cash flows after they pay their debt holders. So we can do that. And that's what Warren Buffett says to do. You're buying a company. You're not buying a stock, you're buying a company. What's the cash flows of the company? Because if they pay dividends, they may pay a dividend of $2 per share, but they could have paid $3 if they wanted to. So that dividend is somewhat of an artificial number. And so it gets a lot more difficult. For some assets, that forecast is very, very, very easy. For some assets, it's very, very difficult. What if I did gold? So let's say you buy 3 bars of gold. What's your future cash flow on gold? Does it pay a dividend? No cash flow. So what's your future cash flow on gold? Yeah, zero until when? until you sell it. If an asset's only future cash flow is its future sales price, that's called a speculative asset. Speculative. Speculative asset. Gold, silver, platinum, raw land. Raw land, not only does it not have a future, it doesn't have a cash flow inflow, it actually has a cash outflow because you have to pay property tax, you gotta, gotta maintain it. So there are some speculative assets that are actually negative cash until you sell it or you put something on it. So those are called speculative assets. We're not going to touch those. I can't tell you what gold's going to be worth in 5 years. Not only can I not tell you, when I was head of equities, the guy who ran the gold fund, he worked for me, which is kind of humorous because he was 10 times smarter than I was, but he worked for me. And my boss would always ask him, what do you think gold's worth? And he wouldn't answer. He was the head of the gold fund. And he wouldn't answer that question. He says, nobody knows. And he was very honest. He said, we used to say an ounce of gold is the same as a really nice men's suit, but we don't say that anymore because men don't wear suits anymore. So we don't even know, we don't even have that comparison. So we don't really know. There's no way to judge that. So it's a speculative asset. We really don't know the future of that. Now, oil is a little different. Is there a cash flow for oil? Yeah, you can sell oil, you can process it. So different assets, different risk. So we're going to ignore speculative assets because there's really nothing for us to do. So those of you I do in the condo, you somewhat have, it's kind of a combination of a cash flow because you know what rent you're going to get, but then you're also going to resell it in 5 or 10 years. That's the speculative asset aspect of it. What you're going to do that, you have to just run some scenarios. And you have some basis for that, where you can look at what real estate prices have done in the past and give you some basis for that. Same thing with gold. We can say, what has gold done in the past? But it's a little more difficult. So some assets have kind of a combination of cash flows and a speculative aspect. No, you're doing today going forward. You can certainly look back and see what real estate prices have done. There's plenty. I don't know if Fred will do that. There's something called median home prices. And you can certainly download that and just see. So for your project, both of y'all projects, this might be something to do. So equal average. The average has been 5.8%. Now I wouldn't use the 5.8. I would probably go out and get one other number. Why is that important? Well, that 5.8%, what was inflation during that time? So you kind of have some sense. And so this number was 64, January 64. So I'm doing analysis you can do in your case, and I'm doing this in like 5 minutes. I mean, this is stuff if I'd done in college, it would have taken me a few years, and y'all can do it in a few minutes. So it's really pretty powerful. So inflation during that time was 6.2%. So you can see real estate has not kept up with inflation. Averages are a little bad because they get skewed, so you can use the median. And then when you use a median, you see real estate as real estate 50% of the time appreciated 5.6% or higher or not. The reason I think inflation is so important is we're starting with a different inflation rate today, and real estate tends to reflect. And John, do y'all know that real estate prices just barely keep up with inflation? People say real estate's a great investment. The problem with this number, that's the price change, assuming you never had to replace the roof, buy new air conditioning, so it's even worse than this. So real estate's it's a depreciating asset. It doesn't just sit there all nice and wonderful all the time. You have to replace stuff. So, but you can see how quickly you can get data to support your assumptions. The other thing you do, Linda, is you could do the percentile. You can say 80% of the time it's ranged from negative 1.3 to positive 13, or you could do it over 5-year periods or whatever, but you can quickly get the data. So you might, with the two doing the real estate project, you might have this as a separate part of your spreadsheet to give you some basis for your high and low scenarios. But it is speculative, who knows what real estate's going to do. All right. So we're going to have a discount rate for this part of the class. I'm just going to give you the discount rate, and then later we're going to figure out how to figure out that discount rate. For bonds, it's pretty straightforward, but for stocks, it's a little more involved. The nice thing about stocks and bonds is we can go out and look at their prices. So why are we doing this? We're figuring out the intrinsic value of an asset, and then we want to compare that to the market value. So we want to say, hey, we think it's worth $50. I can buy it for 45. I'm going to buy it. Sounds like a good deal. Or I think it's worth $100, but it's currently going for 130. I'm not going to do that. Or if you take a firm like GameStop, I think it's worth like $4. Is it currently trading for? Trading for 18. Wow, it's come down quite a bit, hasn't it? Just in the last, so I think it's worth $4 or $5. It's trading for $18. Would I buy it or short it? I'd probably short it, but I wouldn't short GameStop given its history. But yeah, I don't think. I mean, this is a company that how profitable are they? You may know. When's the last time they made money? Minus $1.33, minus 83 cents, minus $1.34. It's been a while since they've made money. When's the last time y'all went to GameStop? Any of y'all use GameStop? You did what? Yeah, it's, I think Microsoft and some of the other online digital are somewhat, they were supposed to go digital, but I don't think they've done that. So my intrinsic value on GameStop is much, much lower than the current stock price. There's no way I would buy this stock. All right. So that's what we're trying to do. Now, in reality, for stocks, we are going to do that. We're going to figure out what we think it's worth. For bonds, we're actually going to be doing it a little differently. In bonds, we're actually going to try to see if we can match the current price. We're essentially trying to calculate the current market price. All right. So bonds, a little bit different analysis, but that's essentially what we want to do. So why are we trying to do this? We're trying to figure out what we think it's worth so that we can make a trade. And this is what it's all about in finance. I think our classes, the textbooks forget this. The reason we're doing all this is to make a decision. You want to make a decision, so you're trying to document that decision. The same thing with your cost-benefit analysis. You want to make a decision, so you need to justify it. And so what we're trying to do here is figure out whether or not we like this stock. Now, on one of your cases, you're actually going to run not just one scenario, but run multiple scenarios. We're going to do what's called a data table, where you're going to set up 50 prices, and you're going to see what percentage of my prices are above or below the current price. Because it's unlikely, if you did a full range on the stock, it's unlikely it's going to be all above the current price or all below. Now with GameStop, if I did GameStop, I think my highest price on GameStop would be below the current price. But that's a kind of unusual stock right now. So we'll run some scenarios just to kind of see what could that range be. And then you're trying to find stocks, and a good way to do this, something you might put into your arsenal, is a football chart. I know it's March Madness, but a football chart. These are really, really cool things. We use this a lot in finance. Some of y'all might think about even doing this for your project. It'd be kind of cool with your project. I'm not sure exactly how you could do it with your project. Essentially, your project can have just one of these bars, but what the football chart says is we valued this stock 6 different ways. When we did the DCF terminal EBITDA, this is the range we got. When we did this, this is the range we got. When we did this, this is the range we got. So you just got these different ranges, and then there's the current price. And what you're trying to see is the current price, is there more downside risk versus more upside potential? And it's a really, really good way to make a decision. Sometimes you can look at it and say, I don't know, that's kind of looks like it's pretty well priced. Sometimes it's really obvious, sometimes it's not. Sometimes it's obvious not to buy it because the current price would be way up here. This, GameStop would be way up here. I can't think of a really cheap stock right now. I had Meta on my list, but they're at $90, but they're not on my list anymore. I sold them at 185, and I'll probably regret that. Where are they up to now? Well, I haven't regretted it yet. We'll see. But yeah, I got them at 90, and then they kind of come up a little bit. So yeah, if I'd done Meta would at $90 would have been down here, and my ranges would have been way up there. Y'all know with Costco, I love Costco, but the current price would be on the higher end right now. So I'm just waiting for Costco to come down in price, so it's in that lower range, and I can buy it. So that's really what we're looking for, is a decision about whether we want to buy or sell the stock. So the present value of future cash flows using a discount rate that's appropriate for how uncertain you are about those cash flows, right? So we'll start with the bonds. So what is a bond? Do I have a definition of a bond?
Sure, it's a sold certificate. We sell it as to get cash from investors, and we dole out interest payments.
Okay, so it pays interest. What's another word for bond? Fixed income is another word. What's another word? You wouldn't call it a bond if you did this yourself personally. What would you call it? A loan, debt, mortgage, car loan, credit card. So bonds are debt, fixed income, loans, any kind of place where you're loaning someone money. And yeah, Jacob is exactly right. It's a contract. So a bond is some kind of contract with scheduled cash flows. Right, so that's what a bond is. That's why we call it fixed income, because you have these scheduled cash flows. So it is a contract. A contract tells you exactly what you're going to get. Very different than stocks. When you buy a stock, there's no contract. You don't know what cash you're going to get. They may be paying $2 dividends, but they can stop doing that tomorrow if they want to. Right. So that's what bonds are. That's why there's so much easier to value a bond, because we know what the scheduled cash flows are. It makes it a lot easier, with one exception. And that's these mortgages. Mortgages are not easy to forecast. Why would a mortgage cash flow not be easy to forecast? It is fixed income, but why is it different than a treasury? What can the mortgage borrower do? Well, reverse mortgage, but that's kind of a mortgage. What can you do if you borrow money in your house at 7%? Refinance. What happens when someone refinances? You thought you were going to get 6% for the next 30 years. Instead, you got all your money back today. Why'd you get all your money back today? Was it because interest rates are really high, or because interest rates are really low? When do people refinance? The rates are really low. So you thought you were going to get 6%. Instead, you get all your money back to reinvest at 3%. You're not very happy, are you? So mortgage is a little unusual, but treasuries Can the US government pay off its debt? If you loan the US government $10,000 at 7% interest and interest rates fall to 3%, can they just pay 10,000 and get rid of it? They can't do that, can they? And Donald Trump said that during his presidency, and it kind of shocked the market a little bit. So we'll just pay off all the US government debt. It's like, yeah, you can't do that. Not at par. You could pay, the current market price if you wanted to, but you can't pay off at par. That would be a really good trick to play. So treasuries, they have to keep paying. If they're paying 6% and rates are currently 2%, they can't refinance. They have to just keep paying and paying and paying. So treasuries are maybe the easiest one of all because they're not going to default. They're going to pay. So we'll start with treasuries. There's a few terms you're going to have to know. One is coupon. Coupon tells you exactly what the cash flow is going to be. Whatever the coupon is, the bond is going to pay that twice a year. Just get used to it being twice a year. Now, when you take the FACT exam, they have bonds on the FACT exam where they only pay coupons once a year. I don't know why they do that because bonds don't do that. Bonds pay, corporate bonds, treasuries, they pay interest twice a year. All right. So if it's a 6% coupon, they're going to pay 3% twice a year. Every 6 months, they'll pay 3%. So $10,000, 6%. That's going to be $600. So they're going to pay you $300 and then $300. That's where we're going to set it up. Then we have the same term over and over again that means the same thing. Par value, principal, maturity value, face value, those all mean the same thing. That's how much money you get back when the bond matures. So if you want to try this, you can go to Treasury direct.gov. I've done this one time in my life. If you're a finance major, I encourage you to do this. Go out and buy a treasury bond. I put $5,000 into a 5-year treasury and almost lost my job. The head of fixed income research, you bought a treasury, you don't buy treasuries here. We buy corporates. It's like, sorry, but I just bought it just to see what it was like. He apologized to me the next day. He got really mad at me, but yeah, I bought a treasury. So if you go in here, you actually bid, you put in your money, and the big players, they actually set the rate. They determine the rate, and you're getting whatever they bid. So Barclays, Morgan Stanley, Goldman, they're all going to bid on the treasury, and that average bid, one might bid 4.5%, one might bid 4.41%, one might bid 4 point whatever. They're going to all bid whatever those big players get. That's the rate you're going to get, and that becomes your treasury. So it's pretty cool. I can't remember doing this because I did it like 30 years ago. I can't remember exactly what I did, but I think it's pretty easy to do. Why is that important? Well, let me show you something that might be a little shocking. How safe is a treasury bond? Pretty secure. So it should have a pretty low rate, shouldn't it? So the US Treasury 5-year is 4.27%. That's what you can get the next 5 years. You can go to JP Morgan and buy a 5-year CD. They're paying 1.5%. Any of y'all want to buy that CD? Does that make sense? Citibank's paying 2.5%. I saw Bank of America was paying 0.03%, essentially nothing. USAA has a 5-year deferred annuity. It's paying 4.5%, so that's a little better. The highest CD I could find out there is a Montreal Bank subsidiary, 4.5%. Or you can go to Treasury Direct, get 4.27. That sounds pretty good. You can buy a Vanguard mutual fund that has corporate bonds in it, a little riskier. That's paying 5.33. That sounds a little more interesting, doesn't it? You can buy a high yield bond fund. Those are those double B, single B bonds. 687 doesn't sound nearly high enough for me because a lot of these are going to default. You'll probably lose 1.5% just at defaults. A tip pays 177, so you'll get 177 plus whatever inflation is. So which of these would you buy? You do which one? The high yield or the? Oh, you would do the high yield. All right, I'm not a high yield. I don't think that's enough. I think if you buy this one, you'll get 5.33. I think if you buy this one, you'll probably get that -1 to 2%. Because you're going to have a lot of defaults, a lot of bankruptcies here, because this is high yield means below investment grade. So, but some people would. I mean, you'll probably get more here than you would there. But if we go into recession, this thing could really blow up. But yeah, that's the risk, right? Would any of y'all do the 427? That's pretty secure. You don't have to worry about it. So most of y'all would prefer the 33 to 687, right? Probably, you can see why the guy told me, why are you buying treasuries? You're getting an extra 1% buying really safe corporates. Why wouldn't you do that? That was his argument with me. Well, this is set in at 427. This can change over time because some bonds are mature, they'll buy new ones. But if you look historically, the starting yield on a bond mutual fund is pretty close to what you'll get the next 5 years. It's a pretty good estimate. So yeah, you'll probably get something pretty close to this. So any of y'all gonna buy the JP Morgan CD? It's FDIC insured, but then so is that. So it's a strange market. I always compare these things. There's sometimes when CD rates are ridiculously high. I don't know how USA is paying 4.5% because they're buying this 533 and their expenses are like 1.5%. So they're losing money on that. I don't know why they're doing that, but they're doing that. So that's the decision we're making. We're trying to figure out, is the price we're paying for this bond worth it given what I'm going to get back? All right. So we'll do that starting after spring break. So you can mull this during spring break. So Thursday's the class. What time will I be here? 1:30. All right. The only thing with 1:30 is, yeah, I'm just, we're gonna have to have an honor system that everybody, so get here as soon as you can before 2:30. So everybody here at least at the same time.